Hi, Kiahi Palaio here, and today we're going to discuss the exciting subject or subjects of basis and stepped up basis. We're going to focus more on the stepped up basis, but we have to understand how to calculate basis before we can do that, or why basis matters. So I'm going to start by saying I'm not giving you tax advice. This is information I know, but don't rely on this for your taxes. You're going to want to seek professional tax advice. Let your accountant drive what your basis is, how to use basis, and any sort of issue that might come from estate planning and stepped up basis. So again, I'm going to reiterate, don't rely on me for your tax advice. All right. Let's start with an understanding of what basis is. And I did a simple presentation here of what basis is. And basis is essentially your original purchase price plus any capital improvements that you've made to the property. And in Hawaii, you may have bought the land at one point, so the purchase of a leasehold interest. All right, so let me go through it again one more time. Original purchase price plus capital improvements, and if you had a leasehold property originally, you purchased the land, you add all of that together and you come up with your basis. And I'm going to tell you why that's important. So let me give you an example. Let's say that somebody you know bought a property for $25,000, all right? And then somewhere in their ownership of it, they put $100,000 into remodeling it, making capital improvements, etc. And so now their basis is $125,000. Original purchase price plus capital improvements. But let's say it was a Bishop Estate or a Kaneohe Ranch property that was leasehold originally. And let's say eventually they pay the lessor $200,000 for the land. So now we have original purchase price plus the capital improvements plus, let's say they paid $200,000. Now our basis in that property is $325,000. Why is that important? Let's say they've owned it 30 years and they decide, hey, we want to sell it. And I'm not going to overly complicate things with exemptions, etc., but let's say it was an investment property and let's say they sold it for $1 million. With a basis of $325,000, they're going to have a $675,000 capital gain, which means they're going to be paying, depending on their tax rate, up to $180,000, $200,000 in capital gains taxes. Certainly it could be less, depending on what their capital gains rates are. Now, we understand basis. Let's talk now about stepped up basis. And stepped up basis has to do with when someone passes away. And under stepped up basis, it's one of the few ways that you can beat the government out of taxes. Bummer is you have to die, right? But let me show you the example I put together, and then let's talk about how it might help you. So under stepped up basis, you have the value as of the date of death. So let's use the same example. Let's say we had $1 million asset, and let's say the human being died. On the day of their death, it was worth $1 million. If that property were sold after their death, that entire $1 million could be tax-free. And again, I'm saying could be, most likely it is, but don't rely on me for your tax advice. Check with your accountants. So, but here's how you can actually use the date of death or determine the date of death. Some accountants will tell you that it's the sales price as long as you sell it before 6 months after the person has died. So if you sold it for $1 million, it theoretically would be tax-free from capital gains taxes. The other way, let's say a human being died 2 years ago, you'd have to get what we call a date of death appraisal. And the date of death appraisal is important because it costs you in today's world $600 to $800, and that will set the value of the property for your heirs. And it's important to understand that stepped up basis is one of the few ways that you can beat the government out of taxes because of the rules. I'm not saying you shouldn't pay taxes, but it allows you to or to follow the rules and theoretically have that $1 million tax free. So let's talk about two different scenarios, one regarding basis and one regarding stepped up basis. And this will give you a perfect example. Under our original scenario, the basis in the property was $325,000. If a person sold the property the day before they died, they would owe taxes on $675,000. The person passes away tonight, and then their estate, their trustee, their personal representative, somebody sells the property after their death for $1 million. They've just converted that $675,000 gain into a non-taxable situation. So that's why basis matters and why stepped up basis matters to real estate and to heirs and to you if you own real estate. If you can plan it properly, give your heirs the stepped up basis. Don't give them the property while you're alive because they're going to inherit your basis. If they ever sell it, they're going to go all the way back to the $325,000 in our example. And if your heir got the property on your death and sold it 10 years later for $2 million, everything above that 325 is taxable. So you want to plan properly. Now, I'm going to give you the disclaimer one more time because I'm sensitive to this. Do not rely on me for tax advice. Seek your individual tax preparer, tax advisors advice on this and confirm that this is how your estate, your unique estate, would handle it. Let me conclude. There's basis and there's stepped up basis. Basis, to make it overly easy, is what's the value of your property for tax purposes during your lifetime, and then what happens to the basis of the property when you die. That's stepped up basis. Important to know, if you have any questions, if you're concerned about this, or you need a referral to a good tax person, it's that time of year when I'm filming this, let me know. And in the meantime, you have a great day.